July's debt numbers sent a message the market can't ignore. The U.S. added $705 billion in a single month, one of the largest peacetime jumps outside of crisis years. But it's not just the size, it's the shape. Short-term funding is surging, foreign buyers are easing off, and rollover risk is building. This is the August 2025 Capital Current Monthly Debt Report, where we break down the numbers, the trends, and the stress points building in America's debt machine. As of July 31st, total U.S. debt stands at $36.9 trillion, up $705 billion in just 1 month, and $1.8 trillion since this time last year. That's a year-over-year growth rate of 5.2%, which sounds modest, until you realize 5% of $36 trillion is a far bigger leap than 5.6% of $5 trillion back in June of 2007. This year-over-year chart tells the story. The brief budget surplus around 2000, the Great Recession spike, the COVID-19 surge, and a relentless upward climb in the years between. The crises change, but the debt keeps growing. And to keep that machine running, foreign buyers are essential. For much of the past 5 years, foreign-held debt levels were flat, but rising Treasury yields have pulled that total back up to nearly $9 trillion last month. Still, their share of our total debt is shrinking, a trend BlackRock warns continuously in their investor outlooks. More of the load is being shouldered domestically and in shorter duration, which carries long-term consequences for rollover risk and funding costs. By instrument, bills surged $212 billion in July, short-term paper that matures in weeks or months. Notes rose $133 billion this month, and nearly $1 trillion year-over-year. Bonds added $36 billion in July, almost 10% higher than last year. Inflation-protected tips shrank $29 billion, and floating rate notes fell nearly 6%, likely a pullback on quickly repricing debt. At the start of 2020, nearly 90% of foreign-held treasuries were long-term commitments. Now, below 85%. That 5-point drop in share might sound minor, but in a $9 trillion market, it's hundreds of billions, shifting into more liquid, short-term paper. This makes the foreign bid far more flighty, yield-sensitive, and politically reactive. The global appetite for U.S. debt hasn't disappeared, but it's on a shorter leash. The country mix is also shifting. China has been in a methodical, multi-year unwind, both in percentage share and total dollar holdings. Japan has plateaued, increasingly treating its treasury holdings as a defensive currency tool, not a growth investment. The UK, France, Canada, and the Cayman Islands have picked up some slack, but even combined, they can't match the historical buying power of China and Japan. China's share of long-term holdings has fallen from 38% to 32% in just a few years. Japan is flat or slightly down. The relative rise of smaller economies' share is less about massive new buying and more about the big players stepping back. The UK just overtook China as the second largest holder at $809 billion, a record high, while China has slipped to $756 billion, its lowest since 2009, after 4 straight months of selling. Much of the UK's increase reflects London's role as a custody hub for hedge funds and global bond portfolios. The key trend? Official foreign demand is no longer a given. Central banks' holdings have stagnated around $3.9 trillion. The heavy lifting is now being done by foreign private investors, who hold over $5 trillion, and by U.S. domestic buyers. The Treasury market isn't collapsing, but the buyer base is tilting toward actors who are quicker to react to yield changes, market volatility, or geopolitical risk. July closed with the 10-year at 4.37%, up 13 basis points. The 20 and 30-year both ended at 4.89%, adding about 10 each. The 2-year jumped 22 basis points to 3.94%. Year over year, the short end has dropped hard, the 1-year down 63 basis points, the 2-year down 35, while the long end is higher, 10-year up, 28, 30-year up, 54. The term premium has doubled from 26 to 52 basis points. A year ago, the curve was inverted. Now it's steepening. Rising long yields mean investors are pricing in more long-term risk. BlackRock is also signaling the return of the term premium, and it signals skepticism about long-term fiscal stability. July interest payments were $96.3 billion, down a third from June's record, but still 8.8% higher than last July. The drop is mostly a timing quirk, not a cost break. Over the last 12 months, interest payments total $1.194 trillion, up $84 billion year over year. The average cost of marketable debt is now 3.399%. Bills cost over 4.31%, notes just above 3.07%, and tips under 1%. Costs aren't exploding month to month, but the rollover cycle is steadily replacing cheap debt with expensive debt, compounding the burden. July's long-duration auctions were mixed. The 10-year on July 9th, solid bid to cover at 2.61, small tail, strong indirect demand, grade neutral to strong. The 20-year on July 23rd was the best, BTC 2.79, low dealer uptake, healthy bidding, grade strong. The 30-year on July 10th was weak to moderate, BTC just 2.38, higher dealer uptake, and a 5.1 basis point tail. The rollover wall is steep. Nearly $5.8 trillion in bills and $4 trillion in notes mature in the next 18 months. That's $482 billion in bills and $220 billion in notes each month. August alone, $1.4 trillion to refinance, almost all short-term and all at higher rates than before. August also brings a 10-year, 20-year, 30-year, and 30-year TIPS auction, plus liquidity support buybacks. This isn't QE. It's swapping older, cheaper debt for new, pricier debt to keep markets functioning. Here's the full picture. Debt is growing faster than the economy, skewing shorter in maturity. Long-term yields are rising. Interest costs are at record highs, and auction strength is uneven. This is debt fragility in real time, under higher for longer rates, with institutional buyers cautious and foreign demand shifting short. Every month, more cheap debt rolls into expensive debt, and the market has to absorb it. Is the U.S. debt coming unsustainable? Drop your thoughts in the comments, and where do you see the stress showing up next? This has been the first Capital Current Monthly Debt Report. Like and subscribe for the latest macro signals impacting U.S. markets.